if anybody who took Benjamin Graham's basic rules, and if you took the basic rules and just sort of modernized them because things have changed a little, but it wouldn't take much change, I think they could do very well. Matter of fact, Benjamin Graham felt that with his simple rules, you might not be able to do extraordinary, but you could do very well. And he proved it many times over. And I'll tell you what really helped me. One day, we were talking about a stock and there was an acquisition. Company was bought out. And so the company paid a lot more for that stock than I thought it was worth. And because I had multiples that I developed, through the Graham philosophy. And I thought, geez, I wonder what these guys see in this company, because based on the Graham philosophy, they paid almost 50% more than it's worth. So I started studying acquisitions. And I realized if these guys in the business, they spent their whole life in it. If I was going to buy another money management firm, you know that I would know what to pay for it because I've been in it for 40 years and I'm certainly not going to overpay for it, right? So if I'm willing to pay that much, as a businessman, I must be able to pay that much and still make money. So what I did is that got me to thinking, one of the rules I'm going to do is I'm going to follow every acquisition. So whenever I read about an acquisition, I would cut out the article in the newspaper, I'd get the value line or the Standard & Poor's sheet, throw it into a shoebox, and on the weekend I'd come and run every ratio, price to book, price to sales. Now we use enterprise value to sales, price to EBITDA, and all that. They didn't call it EBITDA at that time, but price to operating earnings, so forth and so on. And so I categorized all these acquisitions. And then after a while, I had so many of them, I said, okay, this was the acquisition price for a retailer, and this is the acquisition price for a manufacturing. And then I would compare it to the Graham philosophy. And then I added that onto the Graham philosophy by saying, here's how low it can go, because I would see over many cycles, how low the stock could go. But this is how high it can go, because the ultimate price of a stock is what sophisticated buyers and sellers are willing to pay for it. And that usually is about 20% more than what the stock is trading for in the market. So now I had an overview, an acquisition file. I called it the private market value template. And I would take every stock and say, if it was bought out, this is what they pay for it. And I didn't figure this out. The other guys did, the people who were buying these companies. So then I started to realize that the highest the stock would go in the market is about 80% of what a sophisticated buyer would pay, because if you can control the company, you're willing to pay a little more because you can move the levers around. So that became my sell point. So now I had a sell point that was about as rich as it can get, 80% of private market value. And then I reduced it, saying, how much of a discount do I want to make to buy this company? So I started grouping the companies together, and I realized that big cap stocks, big companies, are usually the cheapest you're going to get is about a 50% discount from private market value. The medium companies are about 60, 65, and the small caps about 75%. So then when I get a small cap company, I say, okay, here's the price of the stock. I'm going to buy it. My worst case is going to be 25% of that private market value. So that became my worst case if something happens. Then I say, okay, I'm willing to pay a little bit more because I don't want to miss it. You run a risk of missing it. So then I worked out a ratio so that I said, if I have a company that's worth $30, $36 private market value, $30 is the sell point. Then I'd want to buy it, and I look down and see how cheap it can get. It can get to about 12. So if I buy it at 15, I've got 3 points on the downside and 15 on the upside. So I've got a 5-to-1 ratio. That turned out to be a good ratio, 5-to-1, 3 on the downside, 15 on the upside, 5-to-1. Now look what happens if you pay $17. If you pay $17, you got 5 on the downside and 3, right? And you reduced your reward from 13, you pay 17, you only have 13 on the upside, so you divide the 13 by the 7, and you only got 2.5-to-1 or maybe 3. So you can see by paying up a little bit, you take the reward risk from a 5-to-1 to a 2.5-to-1. So I learned to be very disciplined. I had the private market value, I have my worst case, and then I buy it no more than 20% above the worst case, and that gives me my 5-to-1. And if I have a mid-cap, I might go 4-to-1. And if I have a really great Buffett franchise kind of company, then I would only take a 3-to-1 because you don't want to miss them. So it just came about through natural common sense, watching things in the market. And so any investor can learn this. I do not know more than 4th grade math, but you don't need more than 4th grade math to do these calculations. There isn't anything when you do a financial statement that would take a lot of math. Matter of fact, Benjamin Graham even said, whenever I see formulas that have a lot of formulas, a lot of sophisticated math in it, I distrust them. That's true. You know, think about an immigrant comes over, starts a business, makes $1 billion. Does he know calculus? No. He can barely sign his name, but they make money. You know why? Because they learned the basic rules of thumb. I have 100 different rules of thumb. Scott always tells me, Dad, one of these days you got to publish a book called Rules of Thumb. You don't need all this high math. You don't need all this education. You just need to know business sense. I give you something that my mom taught me that you get a kick out of. As I was graduating, I was, very popular and very successful in my career in gymnastics, but I did very bad in school. And I was getting worried about what I was going to do with my life. And everybody was going on to college, and I didn't want to go to college. I figured that it's not for me. So my mom says, Arnold, what's the matter? You look a little depressed. And I said, yeah, Mom, I'm trying to figure out what I want to do. She says, well, what do you want to do? I says, I want to make some money. I didn't have any money. I was working at a gas station. She says, well, why don't you go into business? I said, business? She says, yes, there's only 2 kinds of people in the world. There's the yucca and there's the businessman. And I said, what's a yucca? She says, a yucca is a guy like your dad. Ask him any question about history, about music, about mathematics, about religion, philosophy, he can answer. Can he make any money? Nothing. She says, now, you take the businessman, take me, she says. Do I know about religion, philosophy, music, mathematics? No. Do I care? No. Do I know how to make money? Yes. So, you want to make money? That was my career counseling. You go into business. I said, okay, that sounds good. Then I thought, well, what kind of business? She says, what difference does it make? Business is you buy something, you sell it, and you make a profit. She says, I only need 3 people. The person I'm going to buy it from, the person I'm going to sell it from, and then Manya, who needs to make some money. So anyway, that got me to thinking about business. But it wasn't until I saw the mutual fund business that I really got hooked. And I said, I was looking, all these years for something to go into. And at first matter of fact, how I got in the insurance business? I read this start your own business. I thought, that's for me. So I went down and interviewed, and the guy gives me this big pitch about how great the insurance business, you build your business and renewals. And I thought, that's great. But I had a job. I was managing a print shop as a supervisor. So I said, you know what? I'd like to try this at night because I'm not sure I can do this. And, I have a pretty good job. And so the guy says, you mean you're going to work your full-time job and work at night too? I said, yeah, because I'd like to work more, and then I can learn the business. And if I like it, I can switch. So he goes, oh my God, you're going to be great. And I said, okay. So he sent me out. I went knocking on doors. And after about 3 months, I got the hang of it, and I was doing better than I was doing at the print shop. So I quit the print shop. And then I started selling. And then as I started analyzing the insurance business, I thought, this is not good for the people. The kind of policies they want you to sell, they make you a lot of money, but it's not the best for the people. And so I started selling term insurance. But in term insurance, you don't make any money. So that was another struggle I had here. I was selling the term insurance, not making any money, and then the mutual funds fall apart. So I was in trouble. But when I got into the mutual fund, I said, now I know I'm going to give up the insurance business. I'm going to go into this, and then the market collapsed, and there I am. So it was a long, hard journey, but the point is you can do it.